Monetary policy, Treasury market resilience, and economic prosperity will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled U.S. Treasury Debt in the Monetary System. Without objection, all members will have 5 legislative days within which to submit extemporaneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Welcome to the next hearing of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity. This hearing is entitled U.S. Treasury Debt in the Monetary System. Today, we will evaluate the health of the U.S. Treasury market and hear from our expert panelists on where improvements can be made. The U.S. Treasury market is the deepest, strongest, and most liquid in the world. As such, it is the foundation of the global financial system, and we must safeguard its status and functions. The Treasury market is invaluable because of its multifunctionality. It equips investors with a safe investment in times of market stress. It serves as a risk-free benchmark for other financial instruments. It is also used to finance government operations and manage our debt, in addition to being used as an essential tool with which the Fed conducts monetary policy. Put simply, U.S. Treasuries are the most essential asset class to the global economy. The willingness of global investors to hold treasuries, attracted by their low risk and high liquidity, is unrivaled. However, the Treasury market has undergone fundamental changes. First, the volume of U.S. debt has been rapidly increasing. Our national debt has skyrocketed to over $35 trillion. Supply chain constraints, global conflicts, and irresponsible fiscal policy have contributed to unparalleled and unsustainable growth of our national debt. The Treasury Department must market this debt to investors to meet spending obligations. With more than $28 trillion outstanding, the Treasury market has doubled in the last decade alone. Second, paired with this explosion in Treasury debt, there are challenging conditions for market participants. The last decade has brought significant changes in technology and regulation, which have impacted the capacity of dealers to provide market liquidity in periods of stress. This was underscored most recently in March of 2020, where dynamic volatility in the Treasury market required the Federal Reserve to step in to calm the markets. We'll hear today from our witnesses about what these changes mean for the market and how we should respond. Today's hearing will also discuss how the Treasury market is an essential tool for the Fed's monetary policy goals. The Fed currently holds more than $4 trillion of Treasuries on its balance sheet, the largest single holder of Treasury debt. The composition of the Fed's balance sheet has a profound impact on market conditions and economic stability. We must ensure that the Fed's monetary policy functions aren't impeding the health of the Treasury market. An efficient and resilient Treasury market is paramount to U.S. leadership abroad and the dollar's status as the world's reserve currency. This privilege cannot be jeopardized. We must prioritize greater liquidity of the Treasury market for the United States, for the investor, and for the taxpayer. And with that, I yield back. The chair now recognizes the ranking member of the task force, Mr. Vargas, for 4 minutes for an opening statement.
Thank you very much, Mr. Chairman, and thank you for convening this hearing. I also want to thank all the witnesses for being here today. Thank you very much. We appreciate it. Before we discuss the issue of Treasury market resilience, we can't ignore the larger threat to our country's economy. Whether it's indiscriminate tariffs or increasing the deficit to cut taxes for the wealthy, President Trump's economic policies are making Americans feel less and less confident about the economic future. We see this in consumer sentiment data. The Conference Board's Consumer Confidence Index has fallen to its lowest level since January of 2021. The University of Michigan's Consumer Sentiment Survey for March had its lowest reading since November of 2022. And it's not just consumers that are feeling these effects. Businesses are tired of the chaos and the uncertainty. A survey conducted by the Federal Reserve Bank of Dallas had one executive respond, "How can you do business planning with all the uncertainty and all the daily changes in the direction made by the Trump administration?" And the small business owners agree. A Harvard Business School study found that more than half of small and mid-sized business owners in the United States expect tariffs enacted by Trump and the Trump administration to increase their operating costs. More than 40% predicted that their sales would decline because of the tariffs. On Friday, Chairman Powell cautioned that these tariffs are significantly larger than expected, and the same is likely to be true for the effects which quote, will include higher inflation and slower growth. And these tariffs won't just hurt the 62% of Americans who have exposure to the stock market. According to a recent analysis from a research center at Yale, these tariffs will cost the average U.S. household an estimated $3,800. Others have estimated that households could end up paying almost $8,000 more because of Trump's tariffs. This economic tsunami is going to hit working class and middle class Americans the hardest. So not only are these tariffs a tax on Americans, they are a textbook example of the kind of regressive tax that will be borne by most of the people who have the least. So how does this uncertainty affect our Treasury market? Not only is the Treasury market the deepest and most liquid market, but as former Secretary Janet Yellen put it, it is the very bedrock of the global financial system. The U.S. Treasury market is so important because investors have come to trust the stability and the credit of the United States. Yet, less than 80 days into his term, President Trump has shown he's willing to gamble away the stability by picking a trade fight with the rest of the world. A recent Bloomberg article warned that foreign investors may also lose interest in purchasing more treasuries due to President Trump's actions. So today we talk about what we can do to make our Treasury market more resilient. We can't lose sight of the biggest threat to our economy, the Trump tariffs. And this ongoing tumult makes the resilience of our Treasury market all the more important. Within the Treasury market, we should always be looking for ways to improve efficiency, resilience, and overall functionality. This includes looking at the supplemental leverage ratio, SLR, to make sure that the intermediaries are not disincentivized to hold low-risk assets like treasuries. And we must simultaneously make sure that the intermediaries remain well-capitalized to maintain the safety and soundness of our economy. Central clearing is another way we can strengthen our Treasury market and continue to mitigate risk. The SEC's effort to increase the number of Treasury markets transactions that are centrally cleared is laudable, and it is good to see that the market participants are committed to a collaborative approach to make sure that we reduce the risk in the Treasury market. I look forward to the discussion, and I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the chairman of the full committee, Mr. Hill, for 1 minute.
I thank Chairman Lucas. Appreciate the panel being with us today. The Treasury market's the world's largest, most liquid government bond market with $28 trillion of Treasury securities outstanding. It's woven into the fabric of our economy and that of the entire globe. It's the fundamental anchor of the dollar-based reserve currency system. The Treasury market affords investors the opportunity to purchase nearly risk-free assets that facilitate our nation using those favorably priced proceeds to invest in our national priorities. This globally critical role of the Treasury market requires our attention. While the Treasury is the global safe haven asset for many trading partners, one must note of the most consequential purchaser of the U.S. debt is not a foreign nation, it's the Federal Reserve. Owning over $4 trillion of treasuries through its many rounds of quantitative easing, the Fed is the single largest owner of U.S. debt. However, increasing federal budget deficits and onerous regulations call into question the Treasury market's resilience. A Treasury market that fails to function effectively stops our economic growth from prospering. This hearing is an opportunity to explore the relationships between the Treasury market and examine its securities and how they're utilized for monetary policy. I thank the chairman, and I yield back.
Gentleman yields back. The chair now recognizes the ranking member of the full committee, Ms. Waters, for 1 minute.
Thank you very much. While we examine ways to strengthen the resilience of the Treasury market, it is impossible to ignore the impact of Trump's harmful policies and the damage they are inflicting on the economy. After Trump announced his tariff plan last week, a record $6.6 trillion in wealth was erased in 2 days in the stock market. And there's more pain to come. In fact, Fed Chair Powell has warned that, and I quote, "We face a highly uncertain outlook with elevated risk of both higher unemployment and higher inflation," quote unquote. So much for the lower cost for consumers. Now, Republicans are trying to pass a budget loaded with $7 trillion in tax cuts for the wealthy, while they slash Medicaid by $880 billion. If we want lower prices, more jobs, and a stable market, Trump and the Republicans should promptly reverse course. Thank you. There's a lot more I could say, but I just yield back the balance of my time.
Chair thanks the gentlelady. And notes to my colleagues that presently we are scheduled to have a couple of votes, but since the floor has not been called into session, I'm inclined, with the agreement of my ranking member, to proceed with the testimony because your time is extremely valuable, my friends. But at a certain point in the votes, we'll suspend and return. With that, today I'd like to welcome the testimony of Mr. Tom Wipf, who is the Managing Director of USB, currently serving as the CEO of the Credit Suisse U.S. entities, and the Honorable Scott Omalia, who is the CEO of the International Swaps and Derivatives Association. Also, Professor Kristin Forbes, who is the Jerome and Dorothy Limson Professor of International Economics and Management at MIT Sloan School of Management, and the Honorable Nellie Liang, who is a Senior Fellow, Economic Studies at the Brookings Institute. We thank you for taking the time to be here, and you each will be recognized for 5 minutes to give an oral presentation of your testimony. And without objection, your written statements will be entered into the record. Let's begin with you, Mr. Wipf. You are recognized for 5 minutes for your oral remarks.
Very good. Chairman Lucas, Ranking Member Vargas, and distinguished members of the task force, thank you for the opportunity to testify today on the United States Treasury market. My name is Tom Wipf. I'm a Managing Director at UBS, where I currently lead the integration of the Credit Suisse acquisition. I'm here today as a board member of the Securities Industry and Financial Markets Association. As well, from 2007 through 2019, I served as the chair of the Treasury Market Practices Group, or the TMPG, a group sponsored by the Federal Reserve Bank of New York that focuses on the integrity and efficiency of the Treasury market. I've also had the pleasure of testifying before this committee in 2021 when I served as chair of the Alternative Reference Rate Committee, or the ARC, a group of private sector market participants convened by the Fed to ensure a successful transition from LIBOR. The U.S. Treasury market is the largest and most liquid bond market on the planet. Its smooth functioning is essential to achieving the lowest cost to taxpayers in connection with the financing of our debt and the efficient operation of the financial system. Backed by the full faith and credit of the United States government, Treasuries are considered by market participants to be the benchmark credit. Treasury yields have an impact on the rates that consumers, businesses, and governments across the globe pay to borrow money. In addition, the U.S. Treasury repo market is a key transmission mechanism for U.S. monetary policy. The Treasury markets operate through primary dealers, banks, and broker-dealers that have been designated as counterparties of the Fed. They are the largest buyers of new Treasury debt and act as market makers or intermediaries in the secondary market. Treasury securities are widely held and actively traded by public and private institutions, particularly financial institutions. The Treasury market has grown significantly in recent years, with $28 trillion in Treasury securities outstanding today, which is more than double the total from 2016 of $13.9 trillion. This growth trend is likely to continue. While the market has expanded significantly, the capacity for dealers to intermediate has become increasingly constrained by the application of additional capital and prudential requirements. One example is a supplementary leverage ratio. The SLR and other leverage requirements are intended to be risk-agnostic backstops to risk-based capital requirements. However, they do create binding constraints for some large dealer banks, reducing their capacity to intermediate the Treasury markets. Another is the original Basel III proposal's fundamental review of the trading book, which would disincentivize banks from market making in U.S. Treasuries. Additionally, proposed revisions to the G-SIB surcharge would inhibit liquidity in the Treasury futures market. Today, U.S. Treasury transactions are either settled bilaterally or centrally cleared. The SEC finalized a rule in December of 2023 on the clearing of U.S. Treasury securities, which will require most market participants to centrally clear eligible cash and repo transactions. We at SIFMA remain steadfast in our efforts to operationalize the clearing mandate. Over the past year, SIFMA has been working with its members, both buy and sell side, and other market participants to develop standardized documentation, policies, and procedures to facilitate the transition to mandated central clearing. At the same time, SIFMA and its member firms were gratified to see SEC Acting Chairman Ueda extend the implementation date for mandated central clearing of Treasury securities and repo. This additional time will help ensure a smooth transition and avoid disruption. We also think the SEC could make certain technical fixes to the rule that I'll cover in greater detail in my written remarks. I'll close where I started. The U.S. Treasury market remains the most important financial market in the world. Any reform of the Treasury market should enhance liquidity, market resiliency, and preserve the capacity of dealers and other market participants to meet the growing demand for and supply of Treasury securities. Thank you.
Gentleman yields back. The chair now recognizes Mr. Omalia. You are recognized for 5 minutes for your oral remarks, please.
Chairman Lucas, Ranking Member Vargas, members of this task force, thank you very much for the opportunity to testify today. The U.S. Treasury market is the deepest, most liquid in the world, as has been stated. Most important changes are coming to it in the form of mandatory requirements to centrally clear Treasury securities. ISDA supports these measures. We also support several important regulatory initiatives that will be fundamental to their success. These initiatives include, first, changes to the supplemental leverage ratio. This should be modified to ensure banks have the balance sheet capacity to provide intermediation and client clearing services in the U.S. Treasury market, including during periods of stress. Second, the Basel III endgame and surcharge for globally systemic banks, or the GSIB, must be revised to remove any unnecessary and disproportionate tax on clearing. Third, margining and capital treatment of client clearing exposures must be revised to reflect the actual risk of clients' overall portfolio. Fourth and finally, it's important that policymakers, market infrastructure providers, and market participants continue to work together to address the various operational, legal, and regulatory issues related to implementing the clearing mandate. Now let me briefly describe each of these initiatives. First, the SLR. At the height of the global pandemic in April of 2020, concerns about bank intermediation capacity prompted the Federal Reserve to temporarily exclude U.S. Treasuries from the SLR calculation. That's because the SLR serves as a non-risk sensitive constraint on banks that can impede their ability to act as intermediaries, particularly in times of stress. Last year, I sent a letter to the U.S. banking agencies requesting that this exemption be introduced on a permanent basis. The SLR is not part of the Basel Endgame package, so we would need a separate consultation to amend it. We were pleased to hear that Federal Chairman Powell acknowledged this in his February testimony before this committee. That changes are necessary, as well as comments by Secretary Besson and Reserve Governor Bowman drawing attention to this issue as well. A second capital issue is the impact of the U.S. Basel III Endgame rules and the surcharge on GSIBs. It has long been clear that these measures, as currently proposed, are inappropriately calibrated. Nowhere is this more evident than when it comes to clearing. Analysis by ISDA and SIFMA has shown that the Basel proposals and the GSIB surcharge would increase capital on U.S. GSIB client clearing business by more than 80%. This punitive tax is completely at odds with the policy objectives to promote the use of central clearing. It is not aligned with risk and would bring economic viability of the client clearing business into question precisely at the wrong time. A third issue is the efficient clearing of U.S. Treasuries by clients that requires the amount of margin posted to reflect the actual risk of client exposures across their entire portfolio. Capital requirements must also reflect this actual risk. To achieve this, margin offsets across Treasury securities and futures transactions need to be extended to the client positions as well, as they are currently for clearing members. The offsetting risks they need to be recognized when banks determine their exposure to clients under the U.S. capital framework. Without such recognition, bank capital requirements will overstate the risk in a client's portfolio. Fourth, ISDA and its members support the Treasury clearing and believe that it's critical that the markets are able to implement the clearing mandates in a safe and efficient manner. The committee's continued review of the implementation timelines can help do that. Good progress is being made in many areas. ISDA, for example, has published the analysis of various clearing models, conducted multiple education seminars and conferences, and is collaborating with others, including SIFMA, to develop appropriate client documentation. But clearing models and clearinghouse offerings are still under development and will require regulatory approvals to test once they are finalized. Then thousands of counterparties around the world will need to agree to these new terms. In closing, let me reiterate our view that given the pivotal role that U.S. Treasuries play in the derivatives and financial markets, we need to ensure that capital and margin rules support Treasury market liquidity, appropriately reflect risk, and facilitate clearing. We urge policymakers to address necessary corrections in bank capital regulations to ensure that the effective implementation of the clearing mandate. Work to deliver the required legal and operational solutions is already underway, but there is plenty more to do in terms of addressing these issues. ISDA and our members are committed to doing our part to make sure that the market continues to function smoothly and effectively. I'd like to thank the Financial Services Committee and this task force for their attention to this critically important matter. Thank you very much.
Thanks, sir. Dr. Forbes, you're recognized for 5 minutes.
Thank you for inviting me to testify. This task force is an important addition to the oversight provided by Congress. A well-functioning Treasury market and effective monetary policy are both critical foundations of U.S. economic prosperity. And unfortunately, both are facing challenges, even before the volatility of the last few days. So this is an important time to reinforce what has worked well as to consider how to address these new fragilities. In my written testimony, I address 4 related points. First, the importance of the U.S. Treasury market and monetary policy to households, businesses, and the government. Second, the role of the Treasury market for monetary policy. Third, growing risks to the Treasury market. And fourth, growing challenges for monetary policy. For my oral comments today, I'll only cover one of those points, developments and risks in the U.S. Treasury market. But first, let me briefly summarize my background. I'm an economist, and my primary role since receiving my PhD is as a professor at MIT's Sloan School of Management. My academic research addresses questions in monetary policy, financial regulation, capital flows, financial crises, contagion, usually from a multi-country perspective. I've also taken several leaves for policy service, including at the U.S. Treasury Department, as a member of the White House's Council of Economic Advisors, and more recently on the Bank of England's Monetary Policy Committee. When not in public service, I've also been involved in a number of advisory committees and consultant roles. But today, I'm speaking to you in my personal role as an economist and a professor. So now let me turn to today's topic. There are many complex networks we take for granted in our daily lives, from our health to the electricity grid. When one component malfunctions, the disruptions can be severe. The same applies to the U.S. Treasury market. The market is critically important to fund the government, and it is the benchmark for other borrowing costs. A less efficient Treasury market increases not only borrowing costs for the government, but also for mortgages, car loans, and bank loans for your constituents. The Treasury market is also central to implementing monetary policy. Well, as we've heard from almost every speaker today, the Treasury market is the deepest and most liquid financial market in the world. Cracks have recently appeared. Most notable was in March of 2020 when the market became dysfunctional. Some of the underlying fragilities have only worsened since. So let me highlight 4 related developments. First is the increased scale of Treasury issuance. The U.S. budget deficit is forecast by the CBO to be almost $2 trillion this year under current law. This must be financed with new debt issuance, and a growing share of existing debt is in short-term T-bills, which need to be rolled over every year. This combination makes the U.S. Treasury market much more vulnerable to shocks, even if they're just short-lived. Second is the more limited ability of broker-dealers to intermediate between buyers and sellers in the Treasury market, as we've already heard about from the other people today. The capacity of this middleman has simply just not kept up with the increased size of the Treasury market. And this limited capacity could lead to illiquidity, less efficient pricing, volatility, and spikes in borrowing costs. Third is changes in who is purchasing U.S. government debt and how they're doing it. Foreigners are purchasing less, balanced by U.S. institutions purchasing more. Many of these U.S. institutions are hedge funds and asset managers that are not simply buying and holding treasuries, but using a combination of repurchase agreements, futures, derivatives, and hedging strategies combined with high leverage. These developments have benefits and costs, but one risk is that these highly leveraged investors are more prone to the fire sales that trigger market dysfunction. Fourth and finally is shifts in geopolitical alliances and the increased restrictions on trade and financial flows. This could, over time, reduce the demand for U.S. dollars and treasuries. To date, the dollar and treasury market is still dominant, undoubtedly because all the other alternatives have their own challenges. Nonetheless, if foreigners do become more concerned about potential losses, which could occur from high inflation, dollar depreciation, new taxes on their holdings, or restrictions on their ability to buy and sell, this could trigger sudden sales, a sharp dollar depreciation, and increased borrowing costs for our constituents. That's not enough to worry about. Monetary policy also faces an additional set of challenges. Disruptions to trade and supply chains will increase both inflation and unemployment. and central bank independence is under pressure in many countries around the world. An independent central bank will not be able to avoid painful economic adjustments, but can stabilize inflation more quickly, limit the extent of price increases, and require fewer job losses. So to conclude, we are at a historic moment. The global trade and financial architecture is being transformed. Periods of transition create opportunities, but can also aggravate underlying risks and vulnerabilities. The risks to the Treasury market are particularly large today, given the sharp increase in debt and other developments I've highlighted. And any disruptions in the Treasury market will impede the ability of the Fed to stabilize inflation, support employment with moderate long-term interest rates. So the committee's work today has become even more important than just the 2.5 months ago when you were formed. I look forward to your questions.
Thank you, Dr. Dr. Liang, you're recognized for 5 minutes for your oral testimony.
Thank you, Chairman Lucas, Ranking Member Vargas, committee members. I appreciate the opportunity to appear today. I will focus on Treasury market resilience and its importance for monetary policy and financial stability. The Treasury market, as others have said, is key to financing our government at lowest cost to the taxpayer. It is an important channel for Federal Reserve monetary policy. It provides the benchmark risk-free yield curve globally, and it is a key source of safe assets and is used by many financial firms to manage liquidity risk. The Treasury market serves these critical functions because it is the deepest and most liquid market in the world, but that cannot be taken for granted. Electronic trading has increased, and principal trading firms represent most of the trading in electronic interdealer markets. Traditional securities dealers have pulled back from market making after capital standards and risk management practices were strengthened after the global financial crisis, and Treasury debt continues to grow. And the investor base is more price sensitive, as private funds with leverage and redemption pressures have increased their holdings, while the share held by foreign official entities who are less price sensitive has fallen. The Treasury market dysfunction at the onset of the COVID pandemic in March 2020 illustrates these risks. Without liquidity, Treasury prices fell and interest rates rose sharply, an unusual move since investors would typically flee to safe haven treasuries in this type of situation. And market functioning was restored only after the Federal Reserve itself began purchasing huge amounts of Treasury securities to provide liquidity and to ensure the effective transmission of monetary policy. Fortunately, the Fed purchases to restore market functioning were aligned with its monetary policy objectives at the time to stimulate the economy and raise inflation to its 2% target. It is possible, however, that the Fed may confront the need to purchase Treasury securities at a time that it would conflict with its dual mandate. And avoiding this conflict underscores the importance of regulatory reforms to strengthen Treasury market resilience. I'll turn now to some key reforms to strengthen resilience, which are detailed in my written testimony. There have been some significant accomplishments under the umbrella of the Interagency Working Group on Treasury market surveillance. More data on transactions and on hedge funds are now being disclosed, and new data are being collected on an opaque but key segment of the repo market where dealers finance their clients. Treasury initiated a buyback program to allow dealers to sell securities to Treasury to help free up balance sheets, and the Fed put in place 2 standing facilities, including one to finance Treasury repo, which could encourage dealers to invest in capacity to make markets and support liquidity in times of stress. Partial progress has been made in other areas. Of special importance is the SEC's role to mandate more central clearing of Treasuries and repo. Central clearing is used for other assets and can reduce risk by standardizing risk management requirements and increase capacity for intermediation through multilateral netting. There are many complicated operational, accounting, and regulatory issues to resolve, and industry groups are actively engaged and committed to addressing them. They recently received an extension of the deadlines for 1 year, but they should not delay further. Changes should be considered to the supplementary leverage ratio, the SLR, put in place following the global financial crisis. The SLR requires banking firms to hold the same amount of capital for riskless reserves at the central bank as they would for risky assets. One change would be to exclude central bank reserves from the SLR calculation, but importantly, with an adjustment so that there would not be a reduction in total bank capital. Finally, to reduce surges in selling in periods of stress, open-end bond funds should be required to reduce significant liquidity mismatches, which force Treasury sales, and supervisors should prevent excessive leverage of hedge funds in trades such as the cash futures basis trade that can force rapid or disorderly unwinds of positions. These reforms, as well as others in the IAWG workstreams, are complementary and interconnected. Any one on its own would not be enough to significantly increase the resilience of Treasury markets in stress periods, especially as the amount of Treasury debt continues to increase. Thank you. I'd be happy to take your questions.
Thank you, Doctor. And after consulting with the ranking member of the task force, we are now 14 and a half minutes into a 15-minute vote. We'll ask the indulgence of the panel, and the task force will stand at ease until this and the preceding vote, and then let's return for questions. Task force stands at ease.